Welcome, everybody. Excited to bring you our quarter 4 market commentary a little bit early. The reason we're bringing this to you early is because we are making some tactical asset allocation shifts in the portfolio overall to address what we see going on in the marketplace today. 2025 has been far from ordinary thus far. Bouts of extreme volatility coupled with an abundance of macroeconomic and geopolitical uncertainties, and yet risk-taking has been handsomely rewarded due to resilient economic growth and impressive earnings delivery. Our moves earlier this year positioned us to take advantage of relative earnings strength opportunities across geographies, sectors, styles, and themes, and the moves in this rebalance extend further into our highest conviction ideas. Specifically in this rebalance from a broad asset allocation standpoint, we're increasing our overweight to stocks, an increase of the magnitude of 1% from our previous targets across the board. This moves our market risk higher on what we see as a friendlier policy backdrop, while at the same time prudently keeping key portfolio shock absorbers in place. Within equities, we're leaning further into the relative earning strengths of the U.S. over developed markets outside the U.S., maintaining a preference for growth over value domestically with a preference for value over growth abroad. We are also moving overweight emerging markets, partially based upon earning signals, but also on the view that easing policy in the U.S. typically is oxygen for emerging market companies. Thematically, we're increasing our tilt into AI companies, seeking to increase exposure to AI builders and enablers, the picks and shovels of the next industrial revolution. This extends a trade that has worked well up to this point, with companies at the epicenter of the AI theme having experienced significant share price gains, driven by an outstanding growth in underlying earnings delivery. Lastly, within equities, as we see rising fiscal commitments to defense, cybersecurity, and infrastructure, we are introducing exposure to national resilience beneficiaries through defense-oriented stocks. On the bond side of the portfolios, we're maintaining a generally neutral stance on duration, while seeking more granular opportunities to balance upside potential with defense, notably against the backdrop of a tight corporate credit spread, specifically in bond-heavy risk profiles. We're adding to convertible bonds, where we see technology sector-driven upside with the ability to preserve a bond-like floor if growth disappoints. Finally, we are holding on to and modestly increasing exposure to precious metals, as we have seen lower real rates as historically friendly to these assets, in addition to their potential ability to hedge against policy uncertainty, fiscal dominance, and geopolitical tail risks. The bottom line, we believe the Fed is giving us the green light to be selectively bold, repressing our advantage where the odds look good, but keeping our discipline where signals still look murky. In our May rebalance, we highlighted the weakening jobs data, which we believe would soon give the Fed confidence to cut rates before the end of the year. In recent months, as you can see from the chart, job openings have continued to slow and have steadily trended downwards all the way back since 2022. Many employers have not increased or resumed hiring following the volatility we experienced earlier in the year. There are many measures that we can use to assess the health of the labor market. For instance, the unemployment rate is now at the highest level in 4 years, attributable to a number of factors. Initial jobless claims, as shown in the red line of this chart, are on the rise, reaching the highest level in 4 years in the first week of September. At the same time, U.S. job openings have fallen sharply in July and August. The diffusion index from the BLS is an indicator that measures the dispersion of employment gains across industries. The index ranges from 0 to 100, with 50 as the midpoint, indicating an even distribution of job gains and losses across all industries. That index has just dropped below 50, indicating there are more job losses than gains for the first time since COVID. And it is at the lowest level we've seen in 30 years outside of recessions. One of the causes of this recent lack of additional hiring is attributable to tariffs and trade policy shifts, especially in the manufacturing and construction industries. Further complicating hiring decisions are the impacts from the immigration policy and demographic shifts impacting the labor supply. Jobs growth is slowing, and if you strip healthcare out of the jobs data, we're actually seeing negative job growth. Additionally, we're seeing prior reports being revised lower, with a recently historically large downward revision from the BLS of 911,000 fewer jobs in the 12 months through March of 2025. While by many measures the economy remains strong, we see a rapidly cooling labor market as a telltale sign that the Fed is set to cut starting this month. As widely discussed, the Fed has a dual mandate to both promote maximum employment and stable prices. Shifting our focus to inflation for a moment, we show quite an interesting chart here. In 2021, the Fed widely believed that inflation was transitory, driven by pandemic-related supply chain disruptions and the temporary fiscal stimulus. The Fed expected inflation to ease as supply chains normalized and pandemic effects faded. This led to a wait-and-see approach, delaying rate hikes until March of 2022, even though inflation had already hit 7%. There were consequences to this delay as the Fed underwent its most aggressive tightening cycle since the 1980s, raising rates 11 times between March of 2022 and July of 2023, eventually reaching a target range of 5.25 to 5.5%. Post-hiking cycle, inflation receded, but not to low enough levels where the Fed felt comfortable to step in and cut rates. So we remained in a higher rate environment for longer as the labor market was still relatively tight. Now we're seeing a cooling labor market. While there is some tariff-related goods inflation, we continue to expect this adjustment to be a one-time short-term price shock. The overall intermediate-term trend is inflation is generally moderating, especially in key areas such as services and shelter. Core CPI will still elevated at an annualized 3.5%, is in a decent place, and is on a nice trend line lower despite these impacts. The long-term trends of demographic changes and technological innovation gives us confidence that inflation will remain contained, and this puts the Fed in a clear position to embark on a slow and measured path to easing. As of this writing, markets are pricing in a 97% chance of a 25 basis point cut in September, and this expectation has jumped meaningfully after the aforementioned payrolls miss and revisions. This is also supported by the Fed rhetoric trending towards more dovish from peak hawkish levels in 2022. The Fed Speak Index on the left-hand chart analyzes the text of Fed speeches, conferences, and other statements to score the language on a spectrum ranging from hawkish, favoring tighter monetary policy, to dovish, favoring looser monetary policy. As you can see on both 1 and 6 month basis, the Fed is increasingly tailoring their comments to lean more dovish. Fed Chair Powell's Jackson Hole speech in late August signaled a greater willingness to cut rates, citing shifting risks to the labor market. Prior to the symposium, the Fed plot from June of 2025 showed a median projection around 2 cuts for the rest of 2025, in line with market pricing. While we await the updated September 2025 dot plot, looking at the future markets, traders are now looking for quarter point trims at both the October and December meetings, and a total of 6 quarter point cuts by the end of 2026. Some would question if the Fed's actions are independent of political developments, but we have long believed the Fed wants to return to a more neutral policy stance. The data now supports a new level of easing. With the Fed expected to embark on another rate-cutting cycle, this creates a supportive environment for risk assets, evidenced by historical periods of strong market performance. We have non-recessionary cuts, as we have often expressed in prior rebalances. We prescribe the idea of don't fight the Fed and believe the wind is at investors' backs. Beyond monetary policy, let's shift our focus to earnings for a moment. The start of 2025 saw the benefit of diversification into non-U.S. markets, working as international equities outperformed their U.S. counterpart. However, this outperformance did not endure as U.S. equities have outperformed international equities since bottoming out in April due to tariff concerns. Looking at the trailing 12-month period since quarter two, U.S. equities have slightly edged out both international developed and emerging equities in price return. However, the drivers of performance have been starkly different, with the U.S. continuing to deliver double-digit earnings growth over that period. International developed and emerging equities have seen much more muted earnings growth over the last 12 months, delivering low single-digit growth. This means that their price performance has been driven more by multiple expansion and investors attracted to lower relative valuations. The data shown in the charts on the slide look at the trailing 12-month period, but we have seen this be a trend for more than a decade now, where the U.S. companies are materially outpacing the growth of international companies. The persistence of earnings growth in the U.S., and notably the large amount of companies delivering earnings surprises, allows us to feel very comfortable with this positioning. For quarter two, this earnings growth was also broad-based, with growth across most sectors and approximately 82% of companies beating their earnings expectation, compared to a historical rate of just 60%. When evaluating earnings, we find that both earnings surprises and changes in earnings expectations drive returns in significant ways. If we look at specifically expectations, both the U.S. and European earning expectations for 2025, they peaked coming into the year before dropping significantly due to tariff concerns. Entering the summer, we saw a large decoupling between the two regions. The U.S. had experienced a strong rebound in earnings expectations after bottoming late in the spring when the tariff mania was at its peak. U.S. earnings saw robust revisions and positive surprises in quarter two. Europe, on the other hand, has seen a continued rewriting lower of earnings expectations throughout the summer, even as their U.S. counterpart rebounds. This chart shows a great example not only of how the trend lines have changed, but also the levels have changed quite dramatically. This summer's earnings releases are a key piece of information for European equities. Roughly 2/3 of companies abroad report on a semi-annual basis, and so we have a much more accurate picture of trends following a recent refresh of that data. Our signals favoring the U.S. have jumped significantly in the last few months following these updates. As a result, signals relative underweight position in Europe now stands near the 85th percentile of our historical observations. We have seen persistent preference for the US in our signals over the last decade. The large divergence today gives us confidence to tactically lean into the relative preference for the US. While the trailing 12-month returns of the US and international developed equities have looked similar, we have seen pretty significant divergence in terms of winners and losers. While US equities have been led higher by growth stocks, international developed equities have seen strong value outperformance. The dominant story in the US has been the fast-paced expansion of artificial intelligence and the impact that it's had on the mega tech companies. We have seen this trend continue to evolve and grow beyond just the Magnificent Seven, as names like Oracle have been able to capture additional earnings and continue to revise guidance higher. The trend in growth is not a new story, as we have seen this outperformance persist beyond the 12 months shown on the graph. Value stocks have outperformed growth in only 2 of the last 10 calendar years. As this trend continues, the models maintain a preference for growth stocks in the US markets. International developed markets have much less reliance upon the tech trade, as evidenced by the construction of their indices. While tech makes up over a third of the S&P 500, it is less than 8% of the MSCI EAFE index. The larger contributors in the EAFE index have been sectors like financials, which generally have larger tilts to a value factor. In addition to the sector composition, developed market, central bank rate policies, currency effects, and valuation gaps have helped with performance and value cohort. The underperformance of international equities over the last decade has created pockets of opportunities to find attractive multiples ripe for value investing, helping create momentum, and as a result, our models are positioned for this trend to continue. Focusing on some of the more granular themes in the portfolios, in May of this year, we began positioning towards what we view as the most compelling growth story for the next decade, artificial intelligence. We often speak about the hyperscalers, who are the companies like Microsoft and Google, Meta, that operate the computing, storage, networking service for AI. As you can see on the left-hand side, annual spend for these companies has soared to incredible levels over the last few years, in excess of $300 billion annually. Hyperscalers, however, represent just a subset of the total AI infrastructure spend, which is expected to reach $500 billion in 2026, or nearly 2% of GDP growth. Over the next 5 years, estimates are that approximately $6.7 trillion of capex is needed globally on AI infrastructure. We firmly believe that many of the leading companies in the space will continue to outperform beyond what is currently appreciated, and actually view AI as not only being a growth catalyst, but also a defensive hedge, with being underexposed to AI actually presenting an investment risk in our view. Many investors underestimate this risk. The exposure to AI is a hedge against disruption in many other parts of the market and economy. Consider the economic impacts of AI displacing jobs or slowing payroll. As a result, we are positioned the portfolio with a more concentrated focus on AI, while also diversifying across the AI landscape to include beneficiaries beyond the traditional technology sector. By investing in AI, you're getting exposure to the chip manufacturers, the data center builders, the power suppliers, cybersecurity, and more themes that are all associated with the proliferation of artificial intelligence. AI represents a multi-decade structural trend that is growing at a rapid pace, and we view selectivity as key to capitalize on this growth. Well, the build-out of AI infrastructure is well underway. What we're also observing is that AI adoption has also been dramatically increasing. You can think of this route in 3 phases: build-out, adoption, and transformation. On the build-out side, we just highlighted the historic capex cycle that is underway. Investments are pouring in as AI growth is driving a huge demand for infrastructure, from chips to data centers. What we're focusing here now is focusing on adoption and the expansion which AI has made its way into our everyday lives continue to astonish. What we highlight here is that in 2023, only 5% of enterprises were utilizing generative AI in their businesses. Today, that figure has reached 44%, and this number is set to rise to 80% of companies expected to use generative AI by next year. We remain in the very early stage of transformation and how AI is going to reshape the globe. AI could contribute $7 trillion to global GDP growth through 2030, benefiting wide swaths of the economy. We're seeing incredible efficiency gains just from the releases in terms of the hardware and software that are coming out right now. The compute capability per dollar spent from the leading kind of GPU platform is now 2.2 times faster and more efficient than it was just 1 year ago. And those innovations are on a rapid pace for further improvement in the economy itself. The propagation of AI into business operations to raise efficiency is visible, and it's going to become more and more visible as time goes on. One additional theme we're leading into during this rebalance is following government spending trends. Geopolitical fragmentation is reshaping global markets and investing through shifting alliances, dynamic supply chains, new trade barriers, and rising competition over critical technologies and resources. These forces are accelerating investment in national security and resilience, with impacts reaching far beyond traditional defense companies into sectors like aerospace, energy, infrastructure, and tech. This chart shows the annual percentage increase in spending taken from the one big, beautiful bill. You can see significant increases in shipbuilding, cybersecurity, air, and missile defense. The defense theme not only spans sectors but regions as well. A rewiring of global trade, rising nationalism, and competition over emerging technologies may have reoriented national priorities across the world. While the U.S. is leading the way here, global defense spending hit a new record of $2.7 trillion in 2024, a 114% increase from the year 2000. European countries are lifting their self-imposed fiscal spending limits to allocate more towards defense. Germany leading the way in Europe plans to double its defense spending within 5 years. The defense industry can also offer defensive characteristics in portfolios. These stocks act as geopolitical hedges alongside gold in uncertain environments. The theme is driven by strategic priorities rather than economic cycles. We are positioned the portfolios to capture these secular themes, fueled by reinforced fiscal spending, geopolitical activity, and the demand to upgrade aging equipment. So, three common themes here in this rebalance. Number one, increased preference for stocks, particularly in the United States. Economic growth signals are mixed at best, and the labor market has unquestionably softened. Fewer openings, fewer quitters, and more folks filing for unemployment. This deceleration, however, has created space for more accommodative monetary policy. Sure, inflation's still limping around 3%, and its descent has lost some momentum, but market history offers clear guidance. Don't fight the Fed. We're inclined to obey and lean into that tailwind, but with seatbelts on, recognizing that policy and geopolitics can still jolt markets. Number two, we are leaning further into relative earnings strength across the portfolios within equities. We continue to view AI as a defensive hedge as much as a growth catalyst, with demand for high-performance computing infrastructure expected to nearly double annually and the intelligence models built upon it advancing at an even more aggressive pace. We expect generative AI to compound into a force that reshapes entire industries globally. Easing into the U.S. typically softens the dollar, which is oxygen for emerging markets. And number three, finally, we're coupling offense with defensive ballast. Lower real rates are historically friendly to precious metals, so we're keeping and modestly adding to that hedge against policy uncertainty, fiscal dominance, and geopolitical tail risk. Where appropriate, convertible bonds give us a pragmatic way to participate in upside while preserving a bond floor if growth wobbles. And rising fiscal commitments to defense, cybersecurity, and infrastructure underpin our thematic allocation to national resilience beneficiaries. Thank you for joining, and we look forward to catching you next quarter.